Now, here's a big point. Remember this one. It's futile to predict the economy, interest rates, and stock market. I mean, people keep trying to do this. I mean, this would be useful. I would love to know when we get a recession. I'd love to know when interest rates are going to go up or down. I'd love to know when the stock market's going up. That would be helpful. I would like to get next year's Wall Street Journal. So I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes. And
As Peter Lynch mentions, a lot of people waste a lot of their time trying to predict the macroeconomic or geopolitical events, which unfortunately are out of control of any single individual because there are millions of moving parts to the economy and world politics. Nobody could have ever predicted that there would be a COVID-19 pandemic, that Russia would invade Ukraine, that the Federal Reserve would print $6 trillion, or the inflation in the United States would cross 9%. All these events occurred without any one individual precisely knowing when they will occur or how deep they will be. So, these macro events can be classified as either known unknown or unknown unknown. And we should not be wasting too much of our time worrying about these things that are not under our control. With that said, let us listen to the next lesson.
if it's gone down this much already, it can't go any lower. I remember when Polaroid went from 140 to about 107, and people said, if you ever get Polaroid under 100, you've got to buy it. You just back up the truck, buy the stock. Stock you get to 110, then rally, fall 103, you go 112, go 105. They said, gets under 100, buy Polaroid. Polaroid broke 100, people started buying it, and within 9 months, the stock was 18.
In this lesson, Peter Lynch is talking about the risks of bottom fishing. Most investors would assume that just because the stock price has gone down, the stock is cheap or undervalued. While this might be true in some cases, but this does not hold true in case of all stocks. And in fact, you have to be extra careful about investing in stocks that have crashed because there is a likelihood that there is some information that the market knows, which you might miss in your investment thesis. In the recent past, many companies such as Teladoc, Chegg, Citigroup, Xerox, and so on are a good example of stocks that have crashed but never recovered. So just because a stock crashed in prices does not mean it is undervalued. With that said, let us move on to the next lesson.
If it's gone this high already, how can it possibly go lower? Higher, sorry. That Philip Morris, adjusted for splits, sold for 12 cents in 1951. And then it goes to 60 cents in 1961. So it goes up fivefold, and you say to yourself, how much, this never sold for that, but just for splits, you say, how much higher can this go? It's gone up fivefold. They missed the power of Marlboro. They missed there's 220 countries in the world. They missed the cash flow of the company. They missed everything. This stock was a 100-bagger after going up fivefold. But people sold it just saying, how much higher can it go?
Here, Peter Lynch is talking about a very expensive mistake that most investors commit. Once they pick a great stock, they sell it off as soon as the stock doubles or triples, assuming that's all there is to the stock. They miss out on the massive opportunity that lies ahead for a great business. If you had invested in Amazon in 2010, when the stock had already risen 100 times from its listing price, your money would have still multiplied 15 times in the next 14 years till 2024. This can easily be applied to a lot of great businesses that have survived over a very long time. So if you invest in a great business, just because the stock doubled or tripled is not the reason to sell, but instead you should hold it for a very long time. With that said, let us listen to the next lesson.
So I would say if you want to buy a small growth fund or you want to buy a balanced fund that's part bonds and part stocks, you put so much money in, put more in every year, you'll be very pleased in 10, 20, 30 years. Stocks will beat the hell out of money markets. They can beat the hell out of bonds. No group of, you think of it, any corporations, McDonald's, any of these great companies, Marriott, you name it, they've never got together and said, geez, we're really doing well. Why don't we raise the coupon on our bonds? Those bondholders have been really loyal. No.
In this lesson, Peter Lynch says that the stocks have the power to outperform any fixed income assets such as bonds or money market. But the biggest reason why most people fail to take advantage of the stock market is because they pull their money out when the stock market goes down. What Peter Lynch said holds true even today. Over the last 15 years, the returns on S&P 500 have been higher than 10%, whereas most bonds delivered 5% or less. Now let's move on to the next lesson.
Well, you ought to find out why you bought a stock. If you're saying it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money.
because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they're around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. I'll be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
When to sell a stock is the biggest puzzle most investors face. So unless the fundamentals of the business are weak or there is no longer any growth opportunity, there might be little reason to sell the stock. Coca-Cola has been one of the largest holdings in Warren Buffett's portfolio for over 30 years, and it still continues to be one of the key positions in his portfolio. So there is no reason to sell a high-quality growing business unless the fundamentals of the business have changed.
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept onto it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific.
A lot of investors get scared of volatility, and instead of taking advantage of volatility, investors get defensive and stop investing in the market. And as Peter Lynch mentioned, volatility can actually be a great friend of smart investor. And if you do a strong fundamental research, you can in fact profit from volatility. With that said, let us move on to the next lesson.
Well, I think the advantage of putting money into a retirement fund, obviously a Fidelity fund I would prefer, but index fund, whatever it is, put some money aside. It's going to compound tax-free. Start saving earlier. The numbers are amazing.
Maximizing your tax advantage accounts such as 401k or IRA is one of the easiest and yet most profitable investment lessons, especially for younger investors, that will enable compounding of not just your post-tax money, but also the money that you saved on taxes, which you can withdraw at a lower tax rate during your retirement. Often the simplest ideas that get overlooked create the most value for investors. If you find this video helpful, then show your support by liking and subscribing to the channel.